So good afternoon, everyone. My name is Maurya Hanspal, and in this session, we'll continue our sessions on fixed income instruments. And here, I'm gonna talk about like some of the tax saving instruments, which are ultimately the fixed saving instruments also. And also, I would be talking about the instruments which are used for the purpose of retirement also. Okay. So these instruments serve both the purposes. So I would say that three purposes. The first purposes that they serve is fixed rate of interest they are giving, fixed rate of interest. The second that they give is for the purpose of retirement planning. And the third that they give is tax saving. A combination of all these criteria, so amazing it sounds. It's giving all these three benefits. Rarely the instruments give all these three benefits which people want. It should give you a fixed rate of interest because it's ultimately a fixed income instrument. It must be tax saving because ultimately everyone wants to save tax on the interest payments or the return that they're getting. And ultimately, they must have a corpus for their retirement so that they need not need to depend on anyone, even their children as well. Okay. Yeah. So the instruments which comprise all these three features of tax saving, fixed interest payment, and retirement planning. The first one is your PPF or the Public Provident Fund. PPF. Public Provident Fund. So this is for both the salaried and the non-salaried employees. Salaried and the non-salaried employees, but an HUF cannot open it. So basically what you are getting here, you can open, see what basically happens, the companies help you open an employee provident fund account, an EPF account. So what basically happens in this EPF account, if the salaries are less than like 15,000 per month, if the salary of employees is less than 15,000 per month, and the company has more than 20 employees, if the salaries of the employees is less than 15,000 per month, and the number of employees in the company is more than 20, then it is mandatory for the company to open an EPF account, that is the Employee Provident Fund account. But still, if your company is not opening it, you can open a PPF account under the government, like which is available for all the central and the state employees, but also for the private sector employees as well. So just in case if your company does not give you the EPF contribution, 99.999% companies give you the EPF contribution. But just in case if they do not, then you can open a public provident fund account under the government scheme. Okay. So what basically happens in an EPF, around 8.33% it goes towards the employee pension scheme. 3.67% goes to the employee provident fund, and rest, see, like this is basically the breakup because ultimately 12% is being contributed by your employer. I'm talking about the employee provident fund, and 12% is contributed by you, who is the employee. You can also be the employer as well, like if you're a business person. Like 12% is contributed by the person who has appointed you or employed you. So that person is your employer, and 12% is contributed by you as well because you are the employee. Okay, but the one thing you need to know, additional 1% is contributed by the employer, and no one knows about that. Additional 1% is contributed by the employer. Employee, that is you, who have joined the company, you just contribute 12%. But the employer, he contributes 1% extra, and that 1% is divided further into two parts. 0.5% is for your employee deposit linked insurance, EDLI. Employee deposit linked insurance, EDLI. Employee deposit linked insurance. So it is basically just to save the amount that you are contributing, so that a certain amount of contribution can be done for that as well. That is for the employee deposit linked insurance, and the rest 0.5% is for some administrative expenses and paperwork. Okay, so that is the basic division of 1%. So in 99.9% of the companies, the company will be having that EPF account. And if not, you can open a public provident fund account, which is both for the salaried and the non-salaried individuals. and not for an HUF. HUF cannot open it. So the interest that you earn on the public provident fund, that interest is tax free. That interest is tax free. Here you have a lock-in period of 15 years. You have a lock-in period of 15 years, and after 15 years, you can get back your money. But you can also extend it for a further more time, that is for 5 years. So I mean, like, for example, if you invested into the public provident fund in 2020 January, so in 2025 January, the amount would be like with you. Okay, but you can say that I do not want to withdraw this sum and extend my PPF account for further 5 years. So they would be extending a PPF account for further 5 years. Okay, then once these 5 years are over, you can further extend it for more 5 years as well. But then it would be the 5 year limit. Okay, you can invest 500 rupees per month into this PPF account. The minimum amount to be contributed is 500 rupees. And partial withdrawal, if the lock-in period is 15 years, partial withdrawal can be done after 7 years. Some charges might be cut or some penalties might be charged here. But the thing is, you can partially withdraw your amount after 7 years. And the rate of interest changes after time. Like sometimes it's like 7%, sometimes it's 8%, and all these things. Okay. The second instrument that I'm going to talk about is your NSC, National Savings Certificate. NSC, National Saving Certificate. Again, it's a fixed income instrument. So what basically happens, again, the rate of interest changes per time, but that rate of interest, it remains fixed. Okay. So when we talk about the National Savings Certificate, again, the lock-in period that you have here, is 5 years. The minimum amount that you have to invest is 1,000 rupees. I'll just write it down better way. 1,000 rupees you have to like invest minimum. There is no premature withdrawal. Like in case of some death or like some court proceedings or some urgent amount, like when you need, you can have a premature withdrawal, but some charges would be cut for that. Then the interest that you are earning here, is again tax free. So that can be again like one of the good instruments to like invest. Okay. The third which people say is about the tax saving funds. But in the tax saving funds, now like what basically happens in case of a tax saving fund, for interest pay na, like we do not get any tax benefits. We're just having like a lock-in period of 5 years, and interest payment is fixed, but interest payment it is not tax deductible. It is tax deductible, sorry, but you do not get any interest tax free benefits. It's not tax free basically. But like instead of talking about tax free funds now, like you have two kinds of thing. One is the tax free tax saving fund, and the other is the tax free tax saving bonds, and the other is a tax free bonds. So what happens in a tax free bond now, a tax saving bond, you're getting a maximum reduction on your investment till 1,50,000 under section 80cc, and also under section 80ccf additional deduction of 20,000 rupees, मतलब total 1,70,000 की reduction मिल जाती है. But again, the tax savings funds में interest is taxable, तो वहाँ पे interest पे कोई rebate नहीं. Okay. But in tax free funds, अब नाम ही हो गया free, तो वो पे है कि interest पे मतलब कि tax नहीं लगेगा, प्लस 80cc and 80ccf की भी कोई deduction नहीं मिलती. And like when you are selling these bonds, the bonds में केस होता है मान लो कि 3 साल का, राइट? तो अगर 3 साल बाद सेल करो तो टैक्स लगेगा, either like 10% without indexation or 20% with indexation. So basically we came to the conclusion, in tax saving bonds 5 years का lock in period होता है, but there is tax on interest, but your investment is tax deductible up to the extent of 1,50,000 under section 80cc and additional 20,000 under section 80ccf. But since when we talk about the tax free bonds, अब वो free बात आ गई है, तो मतलब interest पे tax नहीं लग रहा है, बट डिडक्शन भी नहीं मिल रही है. द ओनली बेनिफिट दैट यू गेट इज इंटरेस्ट पे टैक्स. ठीक है. बाकी अगर लॉन्ग टर्म कैपिटल गेन्स टैक्स अगर होगा तो 10% विदाउट इंडेक्सेशन और 20% विद इंडेक्सेशन आफ्टर 3 years. Okay, that's all for